little bit of experience sharing with us is Dr. Siddharth Das. Dr. Siddharth Das has over 30 years of experience in venture capital, product development, R&D, general management, and strategy. Myself and Siddharth Das, we go back about 20 years when we both moved to India from Intel. He moved from Santa Clara. I moved from Sacramento to Intel Bangalore. And that's how we came to know each other. And since then, we have been keeping in touch with each other, and we have been good friends for quite some time, family friends too. He is the co-founder and general manager of Bangalore-based venture capital firm, Venture East, and investment advisory. And they do investments. For the last 14 years, Venture East has focused on early and early growth stage investments in technology and life sciences. Prior to this, Dr. Das was with Intel Corporation for about 14 years. Among his portfolios is a stint as a country head, corporate affairs and strategy in India. He spent 3 years as a research scientist, component research at Intel Labs. And Dr. Das graduated with distinction from IIT Delhi with a BTech in chemical engineering. Post that, he got a MS from Penn State University and a PhD in chemical engineering from Cornell University. He has a very colorful educational qualification as well as experience. And welcome, Dr. Siddharth Das, and welcome to the TiE. And as we indicated to you earlier, this is about quite a few teams of TiE Global Pitch Fest competition who have won. And from each chapter, there are 3 teams which are representing that chapter who will be here today. And they're all young graduates from universities who are trying to get funding for their companies or their ideas. And they are at different stages in their ideas. Okay, so stage is yours. Thank you very much for accepting and coming in and working with us. Thank you.
Thank you. For the attendees, please answer the poll, which will stay open for 2 minutes. All yours, Dr. Das. Thanks so much for joining us.
Yeah, thank you, Mahesh. Thank you for the very kind introduction, and it's always a pleasure to attend TiE forums. I was quite active in the TiE chapter in Bangalore, but that was almost 15-20 years ago. Of course, as you know, Bangalore has progressed as a startup hub in India, the leading startup hub. So there are many other forums and channels here that keeps everyone at a frenzied pace and very busy. So Mahesh, could you put up the slide?
Yes. This is the one, right? Okay.
No, I sent you. Yeah, this is the one.
Yes.
Yeah, this is the one. So let me minimize this.
So everyone can see the slide, right? So do you want me to do anything different? Sid?
Okay. While we're doing that, I'm going to share the. Yeah. Good news is our knowledge level is relatively on the low side as we kick off this particular workshop. So a lot of information that Dr. Das shares will hopefully move the knowledge level up. I hope he's still on. I'm not seeing him.
Sid, are you there?
I'm going to check. if he somehow popped up.
I think his audio and you are still
He's muted, so for some reason, we'll unmute him.
I'm back.
The audio and video is not connected.
Yeah, hopefully this is going to work now. So
Okay.
anyway, good afternoon, good evening to the global audience. Very happy and a privilege to be addressing this session. And hopefully it's going to be interactive with lots of questions from all of you. And the first slide that I'm showing is, this is actually says it all in a sense. Guy Kawasaki is a very well-known Silicon Valley VC. Probably not to the contemporary folks he's as familiar, but certainly he was very well known a couple of decades back. This kind of question is a kind of a rhetorical question that I'm posing to all of you. An aspiring entrepreneur asks, I dropped out of college to start my own tech firm. Although I'm following in the footsteps of quite a few tech billionaires, most of the VCs I meet tell me I'm too young and inexperienced. How do I combat that attitude? This is something very real, and this is something as you progress towards a career in entrepreneurship, you're likely going to face some of these challenges. So here is Guy Kawasaki's answer. You can do three things. Find other VCs, bootstrap so you don't need VCs, or surround yourself with adult supervision that will ameliorate the feelings of the VCs who have already told you this. So it's a very clear kind of an instruction. You have three parts. And I think, obviously, most entrepreneurs start out by bootstrapping. Mahesh is a prime example of bootstrapping his companies, and he's been involved in multiple companies now. So that is clearly the first thing that happens, is that you typically bootstrap with some help from your family and friends, and then you go to some angel investors, and then you go to institutional VCs, and then you go to private equity, depending on how you're scaling your business. So those are kind of the paths, and it depends on the scale, and it depends on what you consider as good timing for going fundraising. So if I could have the next slide, or can I? Okay. So many of you, especially since you are still studying, I assume, most of you, and you might be wondering, you hear a lot of buzz about VC and so on, but what does it really mean? What is the business of venture capital? And I'm not giving you a tongue-in-cheek answer, but really the business is we make mistakes. We make lots of mistakes, and we succeed also, but the proportion of success to failures is low. Was there a question there? Or? So, but I guess the consolation for us is that famous people also make mistakes. So I'm going to read out a few of them. I think there is a world market for about 5 computers. That was the famous T.J. Watson, chairman of IBM. In 1943. The second one, there's no reason for any individual to have a computer in their home. Ken Olsen, president of Digital Equipment Corporation. And these are basically the heroes of our industry. Mahesh and I both belong to the computer industry. And so these are some of the prophetic statements that were made. 640K ought to be enough for anybody. That was Bill Gates in 1981. And no, in answer to just pay us our salary and we'll give you our personal computer designs for free and develop them for you. HP and Atari to Steve Jobs of Apple. And as you know, the rest is history. So so I'll get to the next point, which is, if you can go to the next one. So, so on a serious note, what do venture capitalists really do? I think there is kind of an impression that venture capitalists hang out in a kind of a country club environment, but nothing can be further from the truth. I think some of them do, but they have achieved great success. So, number one, we spot technology and market trends. We work hard. We have a bunch of analysts that track different sectors, that track emerging trends. And we are supposed to spot a sector before it actually becomes a reality. So many times we are looking at basically new markets. That's not to say we don't look at existing markets and see if there is an unmet need or an unfulfilled need and try to address that. So existing markets also offer an opportunity, but certainly a lot of VCs, their branding comes from being able to identify new markets. So Vinod Khosla, one of the pioneers in the industry, obviously is one who did a lot of technology spotting and market trending. So he's the name that comes to mind. Number two, we provide risk capital to what we consider promising startups. And I'll go through the startup criteria. What is promising? What do you have to have by way of a team, by way of a business plan, by way of risk analysis, risk mitigation, and all of that. We help startups grow to scale, which means that once you do an initial round of funding, the company will require subsequent rounds of funding. So VCs, a typical VC, an early stage VC may invest in 2 or 3 rounds. Then it's like a relay race. They hand it over to a growth stage VC or a growth stage private equity firm. And that takes the company to a different scale. And then you have the late stage. And then, of course, you go for either a listing in a public market or you get acquired. All of those things, great things happen. So we do engage with the companies. We are on the board of the companies and we are looking for, obviously, at scale, some profitable exits. So we work very hard on that. So the first one, as I mentioned, the brand equity built on spotting technology and market trends. You would have heard of KPMG, Sequoia, Excel Matrix. These were all the pioneer, Silicon Valley funds, which have also affiliated funds in India, for instance. All 3, Sequoia, Excel Matrix, also have India funds. So if I can go to the next slide. I'm just putting this up and I'll give you a few seconds to kind of absorb this, internalize this. What does it mean? This is the crux of entrepreneurship. This is really what I would consider the focus, where the focus needs to be. Another way of saying this is marketing 101, sales 101. The first slide shows an entrepreneur setting up a business. I assume it's in Alaska or Siberia or somewhere, but he's selling frozen custard. Not a great idea. So this is called business failure, whatever. And so you've got to have a sense of what the market wants. You got to have a sense whether your product fits into the market, which we call the product market fit. Otherwise, you're going to fail. It's not enough just to have an idea. It's important that idea has some validation. The idea has eventually gets to some referenceable customers and can scale. That's basically what it is. If you look at the right-hand side, you just focus on the graph there. What does it show? It shows a business is showing some growth, okay, in the short term. Those are the sales numbers. and then the sales plummet. Now, so very cheekily, the entrepreneur is saying we are a not-for-profit organization, but we didn't plan it that way. You might say the same thing for a lot of startups today, but eventually you have to keep your focus on sales. You've got to be able to sell. If you can't sell, then you're out of business. Investment and financiers can only carry you so far. But if you don't cross that hurdle in terms of how you're going to, sell to customers, you're going to fail. So these are the two failure models I'm showing you. I'm showing you right at the outset because we are going to get into the success criteria. But this is primarily to, I'm not saying this is a shock therapy or anything, but this is the reality. Just look at it as the reality. You've got to focus on these two things. One is marketing, one is sales. And ideation, vision, all goes into the marketing. What do you communicate? Okay, ready for the next one? Now, the other thing that you would hear in our industry is valuations. How much is my business worth? How do I get $100 million valuation? How do I get $1 billion valuation? And here is just, again, one reality check. The peak of inflated expectations is coming from the entrepreneurs. And in a frothy market, which we also call as a bubble, even investors kind of get onto the bandwagon, and the valuations can go up with very rapid fundraising or very rich multiples on certain financial metrics like your revenue, GMV, EBITDA, whatever. So that you reach a peak of inflated expectations. And then the reality takes over. And it's not that the reality always takes you down to the trough of disillusionment. I'm just saying that's just one of the cautionary notes. Yeah, you can get into the trough. And then you have to, again, kind of work yourself up. And that's what entrepreneurship is all about. You got to deal with the rough and the tumble and the roller coaster and all that. So from the trough of disillusionment, you get to the slope of enlightenment, and then hopefully the plateau of productivity, which is basically what we call stable, stable situations, some kind of a stability. I mean, Mahesh is an electrical engineer, so he knows all about under-damped systems and over-damped systems. So this is a classic example of going from an under-damped to a slightly over-damped system. That's what the cycle is all about. Next one. So the reason I mentioned 7 elements is 7 is not a magic number, by the way. I just thought of 7 because I remember reading some book on 7 pillars to success and stuff like that, but that was a few decades back. I don't even recall those 7 pillars of success now because it's been quite a while, but I thought I'll put together my 7 elements of a sound business plan. And this is my own creation. It may be 11, it may be 5, but I just chose 7. It sounded like something that resonates with whatever has been published as a book earlier. So the first one is, you got to have a grand vision. I think many entrepreneurs make the mistake of having, they want to pounce on an opportunity that they think is out there, and they are almost forced into narrowing the vision. So what I would suggest is when you do your planning, blue sky thinking, visioning, at least have a grand vision. You may have to, scale it down, but have the grand vision. And the vision, of course, comes with a great idea to address either, as I mentioned, an existing or a future market need, an unmet need. So this is something that you have to focus that this is a big idea. The venture business is primarily about supporting ideas that can scale, ideas that are transformational, ideas that are disruptive. So keep those in mind as you plan your business vision. Number two, very often we fail because we make it too complicated, communicating to the other side. So there are the usual cliches that, VCs want the 2-minute elevator pitch and all that. I don't believe in too much of that, but the essence is really that the other side needs to understand. Sometimes the entrepreneur may feel that, I am walking on water. Brilliant. I'm all of that. And sometimes the communication to the other side makes the other side feel either confused or very small. That's not a good thing. So you have to communicate what your goals and objectives are and in a language that the other side understands. That is a simple point. It's communication, my boss at Intel Capital always used to say, follow the KISS principle, which is keep it simple and stupid. You don't have to keep it stupid, but certainly keep it simple. The third, very important. This is a very, very important point. You have to think of the competitive landscape, because very often I have entrepreneurs who come and pitch their business plan, and I ask, who's your competition? Oh, we don't have any competition. Maybe not now, but later. If the answer from the entrepreneur is we'll never have competition, then I think the VCs usually stay away from that. Saying that if you don't have any competition now or in the future, you obviously don't have an idea that's going to have a big market. Because if you have a great idea, if you have a big market, why wouldn't other people also try to eat your lunch? So that is something that you have to think very clearly, that if you assume that you have competition and how you're kind of building in some of these protection for yourself, entry barriers. It may not always be IP, it may not always be intellectual property, it may be business velocity, it may be the team that you have put together, it may be the geographies that you operate in, it could be any of those things. But you've got to start thinking, how am I going to compete? You have to compete. There's no such thing as an idea in a vacuum and nobody's going to be challenging you. They will be challenging you. The fourth point. Again, entrepreneurs will come and say, this idea has multiple opportunities. I have revenue opportunity here, 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 and there, 5 different ways to make money. Sometimes we look at that the entrepreneur doesn't have any clarity on what their primary market is. So they are hedging. They're saying if this doesn't work, something else will work. That's like a leap of faith. You got to have a primary market. Because when you have a primary market, you also have a primary strategy, and you have focus and resourcing for that. If you have 5 different things right at the outset, Along the journey, you will have 5 different things, but if you start with 5 different things, you're probably going to get defocused and you probably don't have clarity on what your primary market is. Yeah, it's important to explore adjacent market opportunities, because if you think you're hitting a bit of a wall with the primary market, but you still have a great idea, yeah, please do explore adjacent market opportunities. And importantly, dimensionalize the markets. How big are they? You know, if you go to a venture capitalist and say, my market is $50 million, they're not interested. So those are things you have to kind of think through. The 5th one, you know, we all hear about frenzied fundraising. People close, entrepreneurs close 1 round of funding, then they're back in the market in 6 to 9 months, trying to raise another round. What are you raising the funds for? You got to have a very clear idea. What is it for? Is it, I can understand that if you are in a very deep tech kind of a business where you need to kind of pump in money in the product development, there is a gestation period. You can certainly, you know, you will need multiple rounds of money before you show revenue. But once you cross that phase, then you have to have very clear growth targets and acceleration strategies. The typical question that you'll be asked, obviously, when you say that my revenue is going to triple or quadruple next year, how are you going to do that? What are your acceleration strategies? How much money is required for that? How is the funds going to be deployed? What is it going to be deployed on? Is it on marketing? Is it on brand building? Is it on the you know, product version? What is it? Obviously, expansion of team, etc., etc. So you have to be somewhat you know, granular in terms of you just can't go out there and say, I want to raise $20 million. You've got to explain very clearly what are you going to do with that $20 million. So that was the 5th point. The 6th point, and this is something that we often trip. Even you know, VCs, it's not just the entrepreneurs, but even VCs trip on this. I think I lost the screen. Okay, sorry. It's certain types of businesses will require you to navigate through regulations. If you are in the fintech business in India, obviously you have lots of regulations, RBI, etc. You know, even VCs have a lot of regulations. We have to have the SEBI certified. We have to get you know, RBI approval for certain kinds of outbound investments, and so on and so forth. So one has to be very clear what are the regulations and certification requirements. And this especially applies in the medical field, but it also applies in the field of, you know, this transportation. You know, today you have a lot of these, you know, whether these are, you know, transportation, EV, etc. They all require permission from the government in terms of operating permission in different jurisdictions. Each state has different laws and so on and so forth. So this is where a lot of people trip up. The reason that trip up is not often because they don't know that these are regulated, but often they trip up because they feel that within a certain time horizon, or that these regulations will be eased and that the government will take cognizance. And so there will be easing of some of these stringent regulations and so on. And if it doesn't happen, then you're really in a soup. And which is why a lot of companies in that space have also shut down. Not to speak of COVID being an additional contributor to that mess. And the last thing was, why are investors investing? And, the very straight answer is they want to make money. They hold shares, but those shares have to be liquidated at some point. How do investors exit? So they would have an interest in knowing your thought process. What are you looking at? If you want to run a lifestyle business, then don't take money from investors, because they will be looking for some timelines by which they want to exit. So these are kind of the 7 elements of a sound business plan that you have to work through, because all these questions will come up. I mean, I guarantee that all these questions will be asked. So you better prepare very well on all these points. Okay. So Mahesh, when do we take some questions, or do we?
I think I'm asking whether, I put it in the chat. If they have questions, they can post it there. Dr. Paul Lopez, do you see any questions? I don't see anything in there.
Okay. Do I take a break or do I continue? I mean, do you want to?
We'll just ask all the attendees if they have questions, put them in chat or raise their hand. We'll call on them. I think Mahesh, you can be watching
Sure.
for that. And if not, yeah, go ahead, Siddhartha, and continue until there are questions.
Okay. So the other part of it, which is what are the 7 elements of a great management team? And again, 7 to repeat is a force fit on my part. I mean, it could be 5 or it could be 11. One is, it goes back to the same thing as the business plan. The leadership has to have that clarity of vision. I mean, vision, mission, goals, objectives, all of that has to be broken down. You can't have fuzziness in any of these things, because this is probably one of the most important decisions you're making in your life, which is to become an entrepreneur. A very, very pivotal decision. So you've got to have that clarity of vision as to whether you have a great idea and whether you can communicate that great idea, and whether you can, inspire others, because you're not going to do it alone. You'll have to bring like-minded folks on the team, and whether you can inspire them to join you. The second is resilience. And this is something that in a very frothy environment like now, where there's lots of money from venture capitalists and private equity, you can easily forget this point, but it's a very, very important point, because all investment cycles go through a cycle of ups and downs. So there are peaks and troughs. So resilience. So in the journey of any entrepreneur and in the journey of a startup, you're going to face these cycles, ups and downs. So do you have the resilience? Because it is a roller coaster. And you got to have the mental strength and resilience to stay the course or change course if you're forced to. This is a very, very important quality. In fact, I almost think that this is number 1. If you don't think that you have the resilience, then don't even get into entrepreneurship. It's a very, very tough business. It's a superhero kind of a business. That's what it is. Adaptability. This is where you've got to, all the shibboleths or whatever mantras you've learned and all, you've got to be able to shed that. If the external environment changes, you've got to be able to adapt to the external environment. The external environment is not going to adapt to you, which is the investor class or the sovereign, whatever. They're not going to adapt to you. You have to adapt to them. And you have to expect that these things will change. So adaptability is very important. Sometimes you'll have to jettison your own orthodoxy and embrace something new. Otherwise, you're not going to succeed. I mean, I can give you, I'll get into the examples later, but I can give you examples where people have succeeded because they have been able to just adapt remarkably to extremely tough external environments. The fourth one is, the domain experts, and that starts in the leadership team. Are you guys on a steep learning curve? Are you learning fast enough? Are you, can you be considered experts in certain domains? A generalist is not such a great idea to be in a leadership team, especially in the kind of tech and deep tech environment that we are in. It's all digital, it's all tech, it's all deep tech. You've got to have some domain expertise. You can't have just general management experience and jump into entrepreneurship. It's going to be very hard for you to inspire your team that way. You got to be down in the trenches with them, just working with them, and that requires you at least to pick an expertise. The fifth one, I mean, this is something Mahesh and I have learned, so I threw it in: commitment and focus at Intel. Intel was a remarkable company when we were there in the commitment and focus on deliverables and deadlines. I mean, it was sacrosanct that we had to just commit to management by objectives, quarterly objectives, et cetera, et cetera. Now, some of these things may not apply to a startup in terms of regimentation, but I think what is important here is to note that, the investors are on your board, and every board meeting means that you give them an accounting of how you have spent the last 3 months. What have you achieved? What did you commit to, and what did you achieve? And I can tell you that having been on several boards over the years, it becomes pretty fatiguing if the entrepreneur keeps missing their milestones. And there is even the board energy kind of gets a little low. So it's important that, your stakeholder management, which is your investors, your board members, your customers, employees, all feel excited that the company is actually, meeting its deadlines, achieving its milestones, and, generally operating in a very professional manner. I mean, it's important that during the crunch time, that the leadership team is basically a 24/7 job. I mean, you can't head off to Tahiti or the Bahamas, or that just doesn't work in a startup. And the final point is team chemistry, sticking together. Seen multiple instances of founders, co-founders splitting for various reasons. I'm not going to go deep into the reasons, but it's important that before you join up as a team, founding team, you have to thrash it out. It's almost like that management principle where you do storming, forming, norming. This is the thing, that storming is basically where you thrash it out, you understand each other's hot buttons, and then you form the team, and and then you normalize to a level of professional stability that you can keep the enterprise going. So it's very important. Many times, I mean, this is also very important. I can't, emphasize enough team chemistry, because I've seen so many instances of teams kind of splitting up, and that really is a setback for everyone. It's a setback for certainly the founding team. It's a setback for investors and employees. And this is something that you may not always get it right, but I think at least you have to have that extensive sessions to work differences in philosophy and align on some common base. Otherwise, you're going to be in trouble.
Sid,
Yeah.
there is a question on where do I get my initial investment from one of the participants. Maybe before you go further into this, you may want to take a minute so that you can set the expectation with them.
What is the exact question? Could you repeat it, Mahesh?
Yes, just a second. Exact question is, where can we find initial investments? How can we convince them?
Okay, I mean, that's obviously a very key question, that all entrepreneurs have. Here is, and this is something that I explained right at the outset. There are different stages, okay? If you have an idea and you want to flesh out that idea with a small amount of capital, then the best thing that you can do is reach out to your family and friends and raise a small amount of money to essentially prove the concept. Because what happens is that the two things that happen. One is if you go to an investor, let's say this is an angel investor, they might want a big chunk of your company initially with a small amount of capital. That is up to you whether you want to give up a chunk of the company at that point in time, or do you want to prove the concept to a level of maturity where you can be assured of a higher valuation for the company. So that is one point I would make, is friends and family. The second is that once you get past the friends and family, depending on the stage of the company, you can go to angel investors. Angel investors typically invest, they could be investing anywhere from $50,000 to $250,000. You can convert that in rupees, but I'm just giving you the ballpark, 50 to 250. In some cases, angel investors may even go up to $500,000, but typically that's unlikely. So after that, you really have what is called the seed stage in institutional investors. Seed stage in institutional investors come in typically in the $500,000 to $1 million range. So then they put in the next level of capital. Then you go to the early stage VCs and so on and so forth. So your initial journey, you're better off either using your personal money, if you have, friends and family money, to build some value. Otherwise, any investor might take a big chunk of the company. And then the issue is that with every round of funding that you do, you keep diluting your stake. And at some point, you may get to a stage where you say, why am I working so hard? I only own 5% of the company. Yes. So you don't want to get to that stage. Yes. So okay, unless you have built a unicorn many times over, then it doesn't matter.
Essentially, you're indicating that bootstrap it, find some friends, family, and then go to the next part. For the initial investment, that is the best bet, right? Okay, let's go to the next slide there. So,
this was something that, I had a little bit of difficulty in trying to figure out how much exposure should I give you to all the deals that are happening in the market. And I could, slice and dice it anyway, and I could give you 10 sectors. But I felt that I wanted to abstract it to just these 3, because many things may fall under this. And the takeaway is going to be easier for you to say, these are the 3 sectors rather than giving you 20 subsectors. You may not even remember. So the first one is enterprise software, which you understand, or in its more modern avatar, software as a service. Which means rather than the company selling licensed software, you're offering the software as a service where the client customers can decide payments on some quarterly, monthly, quarterly, annualized cycle. And so the initial outlay, in terms of from the customers is much lower than if they were to license enterprise software. And enterprise software, obviously, that the famous ones like SAP, PeopleSoft, etc., they come in very, very expensive. And only the large corporations can afford licensing that software. So if you look at the SMBs, the small, medium businesses, they're not going to be able to go for SAP or PeopleSoft or, whatever other enterprise software is out there. So that's why SaaS came in as a handy, business model, not only to penetrate the market deeper into the SMB, but also I think, a lot of the marketing approaches or the sales approaches are very different for enterprise software and SaaS. For instance, in enterprise software, you have the traditional feet on the street sales guy who has to go and do multiple sales visits to the client. In SaaS, you can do some insight marketing, digital marketing, and be able to kind of, get more number of clients on your platform in a much more efficient manner. So those are the two basic differences. The second one I was focusing on was IP driven. See, when we talk about intellectual property, a lot of people will say that, yeah, I have IP. What does it mean? A lot of the entrepreneurs. But the way I'm defining IP is a little more narrow, because, a lot of software companies may say that, oh, we have IP, but that IP is a copyright. Okay. And that is a little different from an IP, which is very, very in the form of patents, which are very, very difficult to bypass. Okay. So here I mean it in that sense. So that's why I have limited myself to hardware, middleware, systems, etc., and not so much in the software domain. So that is the second big area. The third big area is the internet and digital enabled businesses, which has been basically expanding for the last 10 years. The first two have been around forever, but the third one really, in India at least, the last 10 years have seen a huge explosion of opportunities in internet and digital enabled businesses. So this is how I have divided the startup environment in India. As I mentioned, there are other ways of slicing and dicing. As you know, it's very fashionable now to attach a tech to everything. So we have fintech, edtech, medtech, everything is a tech. Okay. But many of them might come under the internet digital enabled businesses. Okay. They're not very different. So, Mahesh, why don't you, before I get into this, if you have some general questions, then you can just, I would like to intersperse a little bit of Q&A rather than leave it all to the end. If you have your own questions before I get into the details of each of these sectors.
We're going to take a look at some of the questions based on what you have been talking about, Sid, up to now. You have covered extensively on types of companies, software, hardware, product, IP, SaaS, PaaS, various things in there, characteristics, right?
Yeah.
In all of this, as an investor or a venture, what do you look for? A revenue generating, growth, management credibility, or all of the above? Or what is that which you look before you deep dive into understanding their company's financials, growth, all of that? I mean, there is at some point, as you rightly pointed out, your time is also valuable. You're not going to spend hours together going through it, but you're going to be spending maybe 10, 15 minutes trying to understand what are they doing, what is the technology, what is revenue, what is, I don't know. So can you elaborate further to see to the audience saying that what do you look for as a first part of it before you really take interest in their in their product or software services or what have you?
Sure. Yeah, I can certainly address that. That's a very good question. I'm going to give a little bit of a preview into how we construct our portfolio of investments. So VCs typically look at a portfolio of investments on a graded range where there is something called extremely high risk. Then there is a high risk, and then there is moderate risk. And of course, the simple-minded correlation could be that moderate risk will give you moderate return. High risk will give you higher return, and extremely high risk will give you a bonanza or a windfall. So the portfolio is constructed with that in mind. So we look at certainly we do a risk assessment on the opportunities. For instance, if we have something very extremely high risk, we might take a small bet early in the cycle of that company. So for instance, in our parlance, it's called moonshot, okay? Which means that we put a small amount of money into a new idea. Typically, this new idea is for essentially new markets. Let's say you have a new kind of battery technology, or you have something new in the air, some sunrise industry for the VC sector, like the aerospace and space and all that. So these are called basically taking some moonshots, but we have to get in early, because these companies, if they succeed, then the valuation kind of goes up very fast. Then the second kind of companies, which I would consider as, at least for the last 10 years experience, which are still high risk but high return, are all these internet digital businesses that have different flavors coming at different times. They're either horizontal platforms like the marketplaces, or they're verticals in different industry, whether it's fashion, footwear, etc. So that is certainly high risk, high return, we might come in a little later even. So while we might put in a small amount of money, let's say in a seed stage in a moonshot, we might come in an early stage investing like a Series A in these internet businesses, or Series B. And then we get into the software companies, SaaS companies. Those I consider as moderate risk, moderate return. And here again, the difference is that if I look at the differences in the internet businesses and the software business typically is self-sustaining at a very low revenue threshold. So most of these companies, the moment they hit about $5-6 million, they can sustain without a huge amount of funding. So to that extent, the amount of money that they need to be backed with in terms of capital is on the lower side than compared to an internet digital business, where the entire emphasis is on customer acquisition. And as you know, customer acquisition costs will pile up as you try to reach a large segment of the population. So that's where you burn a lot of cash. So your primary focus is on essentially what may be called a land grab. You want to own as much of the real estate, and you would invest money to grow your presence. Not necessarily that you're going to be profitable, but you want to grow your presence in the market, so that becomes your moat in a sense. If you grow your presence, then it's much more difficult for somebody else to challenge you. So that's how you may not be profitable, but you have a huge presence. And many of these companies, I don't need to mention, are basically in that category. So
Thanks.
okay.
Yeah, thanks. So a follow-up question is that, for example, somebody is trying to be in, let's say, AI, ML, SaaS in healthcare. Do they have to focus on the investors who are, again, compatible with that, or can they go into general category of investors and try to find out, who could be able to invest into it? Or in other terms, now the question is categorizing the investors instead of categorizing the industry. That's the kind of a, if you can kind of put a little bit of a, GAN into this, whether does these startups categorize the investors, or do they just go and try to say, okay, fine, an investor may not be in that area, but it is an interesting area for them. They may pitch or they may put money into it. I hope you understand the question.
Yeah, sure. Again, a very good question. I will try to answer it in the best way I can. See, today the market has become obviously very sophisticated in the sense that there's obviously a lot of private equity and venture capital money. So we are almost in an overfunded situation in India. Naturally, the investors also have to differentiate themselves, because it's possible that a hot startup may have many choices. So typically what happens is that if I look at it from the entrepreneur side, they might want to go to an investor where they have some kind of a track record in that particular sector, and where there is a specific partner, because many of these partners also start focusing on different areas within the fund. So it's important for the entrepreneur to do a little bit of homework rather than say that I'm going to go to fund XYZ. You have to go a little deeper into fund X and say, let's say, who are the partners? What is their experience? What investments have they done? And then, curate the fund managers like that, and then go to specific partners. That way, you may have a better matching of interest, and it's not going to be inefficient. It's going to be a little more efficient. So if I'm doing consumer internet, I know who are the partners who are investing in consumer internet. Go to the funds where these guys are. If I'm doing a software, then similarly. So I would say that unless there are some completely emerging sectors, there's a general level of expertise in many of the fund managers who have been around for a while, which partner takes care of what. Okay.
Yeah, and that also adds value to the startup, right? If they have some amount of knowledge.
Absolutely.
Yes.
Because what the startups have to also realize that since they have to raise multiple rounds of funding, they have to look beyond the immediate funding and see what kind of network that the existing investor brings. Okay.
Yes. Yes.
It's not just the capital, but the network that they come, what kind of introductions that they can make for the next round of funding, or what kind of market introductions they can make in different geographies. Exactly. And so on.
Yes. So one of the follow-up questions to this bootstrapping was that what are the best ways to find angels who are really investing is one of the question from, here. So a follow-up to the bootstrapping.
Sure. See, today, I mean, there is a whole proliferation. Almost every institution of repute has their own alumni chat groups and all that, where these things get floated. Somebody, you have to kind of find these specific chat groups and see if you can insert your idea in those groups, because all of them will have, certainly a number of them may be angel investors with some experience in doing that. So that is the best way. Usually to go to your alumni network is the best way. And that's number one step, because there is a level of familiarity. So I would say start there. And then you may get some further introductions from that group. Otherwise, I don't think that there is any sure shot way to get to the angel who's really interested in your business. Go through the alumni network and then see if there is interest. If you have some business entrepreneurs that you think will be empathetic towards your business idea, maybe you can approach them directly. A lot of these guys who became almost what they call, I forget the term in the US they use. The entrepreneurs who have had windfall and
Correct. HNIs.
They start investing, super investors or whatever, I forget.
Correct.
Super angels.
Yes.
Super angels. So super angels, if you think that your idea will resonate with some of these super angels, you can approach them directly, or you go through your alumni networks. These are usually, the ones that I would suggest.
Okay. We talked about a little bit about the angel investment and then, bootstrapping and the VCs. One of the questions is that, is equity the only avenue of funding for the VC, PE, etc.? Are there other ones, at different stages? How do you measure those stages? Before Series A, Series B, seed funding, whatever you have, such as debt, equity, convertibles, maybe you can elaborate a little bit.
Sure. So I think, in the old days, obviously, the avenues of accessing capital was very limited. So that's why we talked about mainly VCs and friends. And I mean, there were only three categories: friends and family, VCs, and PEs, private equity. Now, I think that there are more, there's certainly more innovative ways of accessing capital. I know that there are some of these organizations which do kind of asset-based financing, factoring, discounting. So if you have some revenues, you can get some financing. There are lots of ways to kind of bridge your capital gap beyond just raising equity. So these are, then of course, if you raise a small amount of equity, you can also get some proportional venture debt. The venture debt firms will, I forget what it keeps changing, but if you raise, let's say, 3 million of equity, maybe you can get 1 million of venture debt. So there are ways to limit the amount of equity raise you need to do with some of these other factoring or venture debt and so on.
So, I mean, somebody has asked the question, are there safe notes, convertible notes, which, these resources, can they help with the startup?
See, convertible notes as an instrument has always been there. It's just that they were either optionally convertible or compulsorily convertible, okay, depending on when the round closes. I mean, there are things like obviously external commercial borrowing, where you could probably structure some kind of convertible instruments. But one will have to explore depending on the stage of the company.
So the concept of safe note for future equity, right? That is there in India. I mean, do Indian VCs support SAFE, for example, for the future equity or what have you?
We haven't experienced that within our fund, but that's not to say that some of the global funds may be exploring more creative options. I don't know. So my honest answer is I don't really know.
Okay. TIE itself has set up an angel fund in India, TIE Angels, that is being very active. And in general, we do almost a deal a month, that kind of a thing. And as you rightly pointed out, it's between 2 to 5 crores in that range. 5 crore is in the upper range, I guess. Usually around 2 crores, 2.5 crores is very common. So that's been, I mean, these are the angels who have been, like myself, I'm one of those, and we do put in some money.
By the way, I wanted to mention that I forgot to mention that there is a very organized network, obviously, of angel networks in different cities. So you have the Chennai Angel, you have the Hyderabad Angels, you have the Mumbai Angels, you have the Indian Angel networks. So all of these are also useful to tap into.
Correct. So other than that, I mean, have you heard of like Kiritsu, various other?
Kiritsu is there. I mean, Kiritsu is really expanding now. So they started out in Chennai, and then now they are kind of expanding their reach in all other cities also. So Kiritsu is another forum, very similar to Chennai Angels, the Kiritsu forum.
Correct. So, I mean, my questions in those was giving an, what you call it as the breadth of various forums where these startups can go to find funding and, what have you.
Right. I mean, one of the things that I would recommend to anyone who's a budding entrepreneur in this webinar is that try and cultivate a relationship with some mentor. If the mentor is influential enough and they have a network, they can usually connect you to the right people. So that is something
you brought in a very excellent point. All these teams have a mentor who is a charter member of a TIE chapter in their area and who's been an entrepreneur themselves. Most of the cases, it is closely matched to the technology or whatever they have done. And that's the kind of a mentor which they have been aligned to. So yes, I mean, you brought out a very good point. I think, not enough is being said about the mentorship. I think, that is the one which makes the connection between them and the investors and what have you in terms of the market opening and, and helping them out. So I think it's very important. One other question, which is a general question in that category, is that are the valuations which are done by an angel the same way as an investor? Do they look at the valuations in different methods, or are they look in the same way? Any thoughts on that from your side?
Yeah, that's an excellent question. It's very different. Actually, the reason it's very different because valuation, if it's a very, very incipient company with just an idea or maybe just the proof of concept, then typically these valuations fall within a band because there's no really commercial metrics. There is really no commercial metrics. I mean, you don't have revenue. All you have is forecasts. And some of those forecasts may be a little way off in the future. So in that sense, there is, when you go to angels, there's typically a band within which they wish to operate, which means that they're not going to give you a very valuation beyond a certain band. Now, when you go to an institutional investor, typically that may still apply to a certain extent, but by the time you go to an institutional investor, typically there is some visibility on either the value of your IP, it's been validated, or there is some closer near-term visibility on revenue forecasts and so on. So they have some metrics to work with. You know, it could be a GMV multiple, it could be a revenue multiple, and so on. Or it could be an IP valuation. If I'm doing some IP and RF or wireless, I have a general idea what kind of M&A have happened with some of these companies, what kind of valuations have been provided. So typically, you know, I may get to a little higher band in the valuation, even without a revenue visibility in the near term.
Good, thank you. One other question which people may ask is that, how does a term sheet look like, and are these term sheets negotiable when we get into the what you call it as after the valuation, the investor puts in a term sheet, and what is a typical term sheet looks like? I mean, maybe we can educate them, give a little bit of a GAN on what do they look for in a term sheet, or what do they need to look for in a term sheet? Can you please?
Sure. So, of course, it's a negotiable. So, you don't get into any kind of signature on a term sheet before it's kind of goes through the usual motion of negotiations from both sides. The investor would like to buy something inexpensive. The entrepreneur would like to sell it to them. Obviously, the more expensive, the better for them. So that is part of the negotiation on the valuation. And the entrepreneur has to put their own arguments, his or her own arguments, in terms of what kind of metrics they are using, or what kind of analysis they have done, market analysis, financial metrics, to essentially assert a certain kind of valuation for the company. So that is one thing. And the investor will come in with their own set of data. So valuation is just one part of it. Then the other more equally important part of it is obviously things like, since you're buying the shares at a premium, what we call preferred, preference shares. So it comes with certain rights which are not given to people who buy shares as common shares. So preference shares have certain rights. So what are those rights? The rights are as follows. Some of them are basically what we call reserve matters, where the investors or the shareholders have to give consent on certain matters, reserve matters, which may be hiring senior management and so on and so forth, compensation, stock options, all those decisions will have to get a consent of the shareholders. The other rights that you have is basically liquidation preference. Since you have put in the money at a significant premium to the common share value, there are certain rights called liquidation preference, which means that in the case the company is liquidated, which means it's sold, then typically the entrepreneurs can the investors can get their money out first from the pool. So if you have a pool, whatever, let's say you have a pool of $100 million, and if the investors have invested a total of $20 million, then the $20 million comes out first. Okay. And then the rest of the pool then could be divided according to the shareholding. That's how it is done. That is called fully participating preferred. Sometimes the entrepreneur may not agree to that because they call it double dipping. the investor get their money out, and then they also participating in. So then what they give the investor is a choice that either you take your 1x or 2x or whatever. Liquidation preference could be 1x of the money you have invested or 2x. So typically it will range from 1 to 2x. It's really more of protecting the investors in case there is a depressed valuation, that they are able to take the money out. So then they have the choice of either taking their 2x out or converting all their shares to common shares, and then it gets distributed according to the shareholding. So that's a simple way. I mean, the math will take care of itself, which one the investors go for, whether it's 2x or conversion to common shares and go according to the shareholding. So that's called liquidation preference. Then there are dividend rights. When you hold preference shares, then there is a dividend associated with each share. If the company declares dividends, then depending on your number of shares you hold, there is a certain value assigned as dividend per share that you will get. Now, having said that, I have to point out that most of the startups in our deep tech domain, they are not encouraged to announce dividends, because the whole idea is that you need to kind of recycle the money for the growth, because these are all early stage companies, and they need to keep the money flowing back into the company for growth and not give out dividends to shareholders. So this is not encouraged by the investors also. So it's not a very common practice, but as a matter of being legally conforming to all the rights, it's always put in the term sheet, dividend rights. But very rarely is it exercised. Then there is information rights, which means that the company will have to give quarterly information to the company, or whatever is the request, monthly MIS or quarterly financials. So that is called information rights. They can't withhold that information from the investors. So then you have something called, what happens if the company, there are some exit timelines. The company and the entrepreneur and the investors agree that the company needs to provide a liquidation event in 5-6 years or whatever, and what if it doesn't happen? So then there's a whole lot of conditions as to what the company needs to do. If it can't list the company, then it has to try and find a strategic buyer. If it can't find a strategic buyer, then whether there is any provision for buyback of shares by the entrepreneurs or promoters from the investors. So all of these are basically more grungy details.
Yeah. Okay. So I think they got a pretty good idea of what is there in the term sheet and what are negotiable items in that term sheet. So any other questions from the participants? If there aren't any more, I think there's going to be a short poll, and then we are kind of pretty much done, unless Sid, you want to talk more about it and you want me to share the screen and go through.
Yeah, I will just go through the last 3 slides, and then if there are any questions.
Okay, let me just.
Yeah, so what I wanted to do was basically show you some of the emerging areas. This is not meant to be, comprehensive. I'm only showing you some emerging areas. There could be many other areas which have already been invested in and continues to be invested in. But this, in my assessment, is some of the new areas, auto ML, auto machine language, narrow AI, and I'll explain what auto ML is. It seems that ML is being applied in such a ubiquitous manner, but that now today we have a shortage of ML engineers, machine language engineers. So one way to overcome that gap is to basically automate ML also. So that's a software basically fix, rather than having actual ML engineers. Narrow AI is where, general AI, you all understand, has to do with some solving some bigger problem through artificial intelligence. Narrow AI is picking some applications which are the low-hanging fruits, like speech recognition, your facial recognition, all that. That all comes in the domain of narrow AI. Cloud technology, what are the challenges in cloud technology? I think mainly as we get into kind of hybrid cloud, private, public, private, we also making the infrastructure agnostic. There are certain, certain developments that are happening in that space. DevOps tools, as we have kind of distributed teams, and it's impossible for, let's say, designating one software engineer to keep monitoring essentially the software development cycle in terms of what's happening, what needs to get fixed. So DevOps tools is a way of monitoring. It's an observation tool that helps monitor across clustered, distributed teams, and so on. Cybersecurity is kind of self-explanatory. You guys all understand why it's important. Blockchain, obviously, I'm talking about beyond crypto. So blockchain, today you're talking about how do you protect intellectual property? You could have a blockchain kind of architecture, then logistics, bank accounting, all of that. Wherever there, then land records, all of that can go into some kind of a blockchain architecture. HR tech.
Sid, I mean, there is a poll. I want all of you to take the poll. Please do. We will continue with the discussion, and just make sure that you have answered the poll. It just takes about 30 seconds. Okay, go ahead, Sid. Thank you. Sorry for the interruption.
So HR tech is the latest. I'm not sure whether it's going to be the greatest disruption, especially in the IT industry, where people are. Can you hear me? I suddenly got a note. Yeah. I think there is certainly in the IT industry, there is a sense that a lot of the skill sets are not being upgraded or have got obsoleted because we have moved from the world of basically project management to now more new areas. All of this, of course, comes in that automation, AI, ML. And so HR tech is one way to also mobility of employees across the organization, rather than making it a very HR intensive process. Can you use AI, ML tools to do the same thing? So that's what HR tech is. So the successful companies, all of you obviously are either familiar or you can look it up. Zoho, Freshworks, MoEngage, Dhruva, these are all very successful companies. Business automation, market engagement platforms, retrieval and storage, and all of that. So these are very, very big names right now.
So the next slide.
Yeah, the IP-driven business has always been a little slow in terms of scaling, because some of it may be that we didn't have a ready market for many of these products in the past. Now, of course, that market is developing. How do you sell kind of hardware and systems in this market? How do you sell chips in this market? You need a market that is very, it's been always a little incipient in that sense. So, but right now I would say the flavors are medical monitoring and diagnostics, because as you know, we are all very, very aggrieved by the cost of, medical diagnostics. I mean, literally, and the whole idea of any kind of entrepreneur ship here is how deep can you penetrate into this market? So how do you help the guys who are in the middle of the pyramid or the bottom of the pyramid? And that's where medical diagnostics, can we get more lower cost monitoring and diagnostics done? And that requires a technology intervention. We need to have some innovation. Autonomous vehicles, again, you understand autonomous vehicles. So there is a lot of companies in India also which are into either LiDAR, radar, all those kinds of technologies for traffic monitoring and so on and so forth for autonomous vehicles. So that's also, there are companies in this space. And then green battery technology, as you know, that we are trying very hard to get away from lead acid. And there's a whole lot of innovations in different kinds of batteries, whether it's aluminum, air, lithium, of course, is there, hydrogen, etc., etc. And then the fourth area is warehouse automation. I mean, clearly, the e-commerce boom has also created this huge demand for warehouse automation because it's just-in-time kind of inventory and and customer fulfillment that are very, very critical at this stage. So warehouse automation has a lot to do with that. So there are some companies like Tejas is more into the telecom 5G boxes. Gray Orange is into warehousing, and Ather is into this EV, which was incubated in IIT Madras. So, and the last slide of the day. Okay, I think you guys probably are most familiar with this area. This is the digital internet enabled businesses. B2C, you understand, it's business to consumer, which is basically businesses which operate with multiple brands and sell to the consumers. D2C is where they are dealing with a single brand, direct to consumers. So these are brand owners who are selling directly to the consumer. And B2B is, of course, business to business. And sometimes there is a small b in the second B, which is large businesses selling to small businesses. So that also is a social commerce. You guys are all familiar with Meesho, etc. So this is also one of those emerging areas that is clearly expanding the reach of classical e-commerce players with social commerce. So the customers, in a way, become kind of the channels to sell to a larger distribution network. FinTech, all of you understand FinTech. This is basically the whole transformation of the financial industry to bring in more kind of automation into that industry and digital technology into that industry, smarter underwriting in that industry. So that's what it is. InsurTech, again, is digital insurance. So you have companies like ACCO. So if you look at below Swiggy, Ola, you're familiar. ACCO is into digital insurance. Redbus was one of the original pioneers in ticketing, online ticketing for buses, and Flipkart. So that's pretty much the end of my pitch. So if there are any other questions, it's 6:30. So I think pretty good time, Mahesh.
Yes, we are pretty much on time. So I think the survey is out. Aryan, can you share the survey so that I think about 85% of the people have improved their knowledge through your presentation, and from high and very high, so about 84%. So you can see that, right?
Yes, that's wonderful. That's wonderful. I'm glad all of you got something out of my gyan.
Yes. Thank you so much, Sid. I owe you one for taking the time.
It was a pleasure, Mahesh, to be participating in this, and thank you again for inviting me.
Thank you. Thank you, and all the participants. That's about done for the day. And at the peak of I think that we had about 55 members at the peak, and as usual, it goes down, and now we have 24 at the end. So it's usual story online. Okay. So thank you so much. And Aryan, we can step out, right? So anything else which you want to announce, Aryan?
No, sir.
Okay. Okay. Thank you. So we can drop out. Thank you. Bye-bye.
Bye.
Thank you, sir. Thank you, sir. Thank you for your.